Peter Eliades with you. This is the Stock Market Cycles update for the week ending August 7th, Friday, August 7th, and it's being recorded on Sunday, August 9th. We've been telling you for a long time now, not a long time, but most of you, or a lot of you, have been asking for, what about the precious metals? Can these cycle projections work with the precious metals? And I'm going to be very honest with you. I have not used them with precious metals for a long time. I used to use them, and they were effective, but I won't say I was overly impressed with their effectiveness. I think we're going to be able to do a lot better job of projecting the precious metals once we get our reverse process taken care of within the programming. And that's a long procedure. That's not going to happen in the next month or two. By a reverse procedure, I mean what you do is you look at a chart and say, okay, what's the exact offset that would have given the exact projection here? And you do that with going back for several years, perhaps several decades, depending on what you're working with. And you'll come up with, I promise you, you'll come up with a series of offsets that will be quite close to the ones we use for equities and equity indexes. They probably won't be exactly the same, but like a nominal 10-week projection with a 5-week offset may be a 4.4-week offset, or a 5.8-week, or even a 6-week offset. You understand what I'm saying. It could be slightly different, and we don't have enough experience with these precious metals projections to tell you we have great confidence in them, okay? We can always use the statistics module and see what it tells us about prior projections, but we're not going to see too much from that either. Let me tell you that this is a chart of GLD. That is the Spider Gold Trust. It's an ETF for gold. You say, well, why don't you use the commodity? I don't use the commodity itself because I don't like to use continuation charts. So many people do them in so many different ways with commodities that I would far prefer to have an ETF that you don't have to adjust prices for as you go on every 3 months into a new expiration. So that's the reason we're using GLD. Now, what I started out with here is a 20-week offset for a nominal 40-week projection, figuring that this big move here is not coming from a very short-term offset. This is a major move that's being made in the metals, and it's probably a longer-term cycle that's producing it. So the 20-week shows us nothing. In fact, the last time there was a crossing was back here. We got a projection that was quickly met, almost a crossing here, but it was, as it so often does, and as any entity, whether it's an individual stock, an index, a commodity. Let's zoom in on this just for a second to show you how these offsets often act as support and resistance. See, gold came down over here, came down, stayed above, came down right here, stayed above, came down right here, stayed above. So it finds support at the offsets, which would indicate that this is probably not a bad offset to use. It gave, I guess this was considered a crossing, but you can see that if that was a crossing, it was by the barest of margins. So I wanted to show you that, though, so you could see the 20-week offset. Let's next go to the 40-week offset, 39 to 40, nominal 78 to 80-week projections. Now, last time we had a crossing here was way back here, okay? And so we'll go out. We keep going out to the longer and longer offsets. This is a 100 to 110, which gives nominal 4-year projections, long-term projections, okay? And there were 2 good projections back here. Wouldn't have done you much good. I mean, this is a broad box, but that's where gold bottomed back at this low in 2018, and then very quickly gave an upside projection, which it came up to. As you see, we extend to the right here, and you can see came virtually exactly up to that projection, and then went sideways for 3, 4, 5 months. Anyway, these were projections that were given and met, but we're into something bigger here now, obviously. What's the next longer-term projection? Well, let's go to 200 to 220. Again, not much to see there for recent price action. Okay, we got an upside projection. Too big a box here to be really helpful, but it came up to the underside of that. This is for 200 to 220. You're talking about 4 to 4.5 year offsets for nominal 8 or 9 year projections. And the longest of all, and I'll show you in a second how to get this, we'll go to input offsets of 400 to 440. Now this is interesting. Look at this. Where does this start? Well, it's taking the low all the way back in August of 2018. Now you say, well, there are a whole bunch of crossings above and below there. Yes, there were, but pay attention to them. Look at the first time you crossed above both offsets, okay? So you crossed above the blue offset here, boom, above it a little bit, come back down, crossed above it here, came back down, crossed above it here. The first time you got above both offsets was right in here, and that's where this projection was given. Another thing to point out, remember when we do weekly projections, we generally use plus or minus 10%. Although we have dual offsets here, we're using 400 to 440. So we don't really need the plus or minus 10%, but you can see them within this projection window. This is the midpoint of the projection. Plus or minus 10% would be these dashed lines. But because we're using a relatively large dual offsets, 400 to 440, you can see the extent of the offsets and the big upside projections provided. And for the first time this past week, we got inside that projection box. So I wish we could give you more on the precious metals, but we can't. Fortunately, if they start to come down, we'll be able to get the shorter term offsets, but I wanted to show you this long term one so you could see what's going on there. Okay, let's get to the stock market now. On the stock market, we're going to look at NDX. Okay, this is NDX, the Nasdaq 100. These are weekly charts, and it's the end of the week. We might as well look at weekly charts, okay? I don't do it often enough, probably, because they give you a broader perspective. You can step back and without trying to do the very short term, and we all like to do the very short term too, especially those of you who like to trade with the shortest charts of all. But it's nice to step back and get a broader perspective. So this is the upside projection, a nominal 20-week upside projection, calling for 10,635.06. Let's check this out. Up to 11,493.54. Okay, so that's the range. Last week's high was 11,282.24. We are right in the heart of this projection window. Now you have to question, are there higher projections? And there are on the S&P and on the DJIA, but watch this. There are not. If you go out to 20 weeks on this, because of the way it sets up, it's actually giving a lower projection. You can't get a longer or a bigger upside projection. Let's go to the next longer offset, 39 to 40. Same thing happens. Here's the upside from the move just below back at the March low. Let's go to the 100 to 110. See how it came down to that offset? But there's no crossing to give us much higher projections here. And finally, let's look at the 200 to 220, way above, okay? So you can imagine, I'm not even going to do the 400 to 440 because we're going to be way above that too. So the important thing to recognize here is, and we kept pointing this out over the past few weeks, the nominal 20-week upside projection is the highest projection outstanding for the Nasdaq, and that's been fully met. Not the upper side of it, but this is telling us that maybe we should be cautious. I've been telling you that now for a few weeks. I'm not calling for a market top, not yet anyway, but I'm saying that this is a potential danger signal, okay? Now let's look at the weekly chart with the S&P cash. Okay, I'm going to show you something interesting here that I don't think we've looked at this before. I don't know why. Maybe way back in March we might have looked at it, but I don't think we've looked at it since the rally began, and this is interesting. This is a 100 to 110 week offset. We use those for nominal 4-year projections. These are long-term projections, okay? But look at this. Let's extend this to the right so you can take a look look at that. The upper side of the nominal 4-year projection is 33.51.51. The high last week, 33.52.54, within 1 point of the upper side of the nominal 4-year projection, okay? So that's another reason that it's at least a preliminary cautionary sign, okay? Now, what makes that seem completely foolish is if we go, this is our 10-week offset with the S&P, and we're pretty close to that, but look at this. We've been showing you this since we go back, I guess, going back to when it crossed above in the middle of July. We have a huge upside projection here. We played around with statistics here and got it up to, let's go to statistics. So that's a pretty low statistic, 54.6. You say, big deal, that's a 50-50 shot. But we can play around with percent of ATR and bring the projection down lower so you won't expect as much. And look what happens. We showed you this the other day, I believe. If we go up to 90% of ATR, it brings it all the way up to 81% of projections met. And all you have to do to get that is take off this little chunk down here. So in other words, if you use for an upside about 3,860, then you get up to 84% chance of success, okay? So this is the way things are interrelating. And we're going to be watching this market very closely, because if we start to get downside projections with any kind of pullback, they could start to snowball to the downside. The great thing about the software is it's going to tell us. If it's just a typical pullback, nominal 10-day, 20-day, 5-week projections, they'll stay above the offsets. You can see what you have to do to break below these offsets. I mean, this is way down around 28, 2,900 over the next couple of months. Chances are this is not going to be invalidated within the next couple of months, okay? So that's what we're looking at. There is no reason from these charts to think that the market, well, I got to be cautious now. I'm going to say that the market's near any kind of high. There is a reason to think that the Nasdaq may be at or within a projected area of an important high. And that's been the lead index. It's been the leading indicator, new all-time highs now for several months. So we have to watch this market very closely. Fortunately, I have this software, and fortunately, you have the videos to watch. We can watch them together, okay? Now, one more chart. And this chart will make you believe that this projection might be hit. I've showed it to you several times, and I've showed you a couple of different versions of it. What I'm going to show you today is the 10-week moving average. We looked, this is the American Association of Individual Investor Sentiment Chart. We've looked at both a 10-week MA of bulls minus bears, and we've looked at single-week bulls minus bears. This is the 10-week MA, and it is a spectacular chart. Take a look at this. I'm dumbfounded by it. This is a 10-week moving average, the blue line, of bulls minus bears. In other words, percent of bulls every week on AAII, and these are individual investors. These are not professionals like Investors Intelligence uses. These are individual investors that go to their website and they tell you which way they think the market's going to be in the next 6 months. Is it going up or going down? Look at this sentiment, 10-week moving average. This reading that we got this week matches up almost exactly with the mid-May reading. But how far back do you have to go before that to match it up? Well, you're looking at it right here. Look at this. I mean, these lows don't even come close. Guess where this is? This is 2009, right at the bottom in March of 2009. What happened to the market after that? Rum-bum, rum-bum, rum-rum, rum-bum, 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 rum. But incredible. Do I think this is telling us we've got another 10-year bull market in front of us? You can bet your bottom dollar that I do not, okay? I still think that we are in the process of making one of the most important market tops in history. Fortunately, we have our projections to guide us through that process. But if you look at this sentiment chart, it's just unbelievable. I mean, now, I've pointed out before that if you go back to 2007 and 2008, this period right in here, yes, sentiment there were very few bulls coming down this the first time. But look what happened. I'm going to put in my little cursor here that shows the vertical and horizontal thing. Okay, so we got down there pretty quickly in 2008. But that was right at this level here. And you can see when you got down there first time to the level we're at now, there was no big downside. You went sideways, sideways, sideways. These are several weeks now, probably a couple of months that you went sideways. And by the time you got into the position where you were going to see a big decline, you had already gotten sentiment up pretty bullish again. They had rallied all the way up to here. And that's where it got vulnerable again for this big decline, okay? And then finally, down to the levels we're at now. Now, go back further. Go back another 10 years, another decade. We never got down to those levels that we see today. Look at this, back here. So, based on this chart, you have to be bullish, unless something is happening that hasn't happened in the last several decades or maybe ever before. With this kind of negative sentiment, to think that the market might be topping here seems to be ridiculous. All right, relatively long update. There was a lot to look at. Thanks for watching. We'll be back Monday evening, afternoon, late afternoon, evening with our next update. Thanks a lot for watching.